What most people don't understand is that there are markets in the United States where that NOI is much easier to hit, that $1 million, than a place like Texas, where you're taking many different hits, including property taxes and insurance. Where if you went to a state that had low property taxes and low insurance, then you don't need to worry about that. And you can hit your net operating income with your rents being much lower. And you don't take the chance of having to raise rents by $250 a unit. You can raise them up by $125 a unit, and you can still get to that math. You can still get to that number. And people are like, yeah, but Texas and Florida are the fastest growing markets, so I want to be in there. And the answer is that's complete rubbish.
Welcome to the Cashflow Project podcast. I'm your host, Steve Fierros with Tri-City Equity Group. Today, I'm super excited. We've got Neal Bawa back on the show. He was with us way back in 2020. I know in real estate terms, that feels like a lifetime ago, but we're at a totally different point in the market at this point. So we're definitely going to pick Neal's brain on that. Back then too, when we last interviewed him, I didn't have the pleasure of having him on the show. He was with Duke and Vince. So please go back and take a look at that episode. That was back in episode 39, again, back from the time vault in 2020. But just to kind of tee Neal up a little bit here for you guys that may not have caught that episode, or you may be a little bit more recent of a listener, Neal is known as the Mad Scientist of Multifamily. He's renowned for his data-driven success, managing $1 billion portfolio, guys. So we definitely have somebody with lots of experience and insight to be able to tap into here on the show today. He's the #1 rated multifamily speaker as he speaks on stages across the nation. He's here to share his insights on how to navigate 2024 for you as an individual investor, or if you're a high-level operator. We'd love to be able to pick his brain. Neal, welcome back to the show.
Well, thank you. It's great to be back on the Cashflow project, and looking forward to an interesting discussion at an interesting time.
Oh, very much so. Very much so. I mean, we're just kind of starting off the year here. Obviously, we're at a very different stage of the market. There's been quite a few different things that have changed over the past couple of years. But for those of our listeners that didn't get a chance to kind of catch that first episode or really have kind of any insight into your backstory, can you just fill us in a little bit and kind of give us a little bit of a brief backstory onto how you got going in real estate and kind of what brought you to where you are today?
Sure. I'm a technologist, computer science degree. Data science is my major. And I've had a successful tech career, took a company from 10 people to 400 people, sold it to private equity. That took 14 years. During that time, I built a bunch of campuses for that company. No investors, just the company's cash. And that got me into real estate, started realizing that I was saving incredible amounts of money. I live in California, so I was spending 53% of my income on taxes. And then 5 years later, after learning about real estate, I was spending no percentage of my income on taxes. So it was a fantastic change. I really enjoyed it. And in 2008, my data science showed that this was the best time ever to buy multifamily. So along with friends and family, I bought dozens of single family homes and transitioned into multifamily in 2013, 2014. That's when I, for the first time, took an investor's dollars. So it's been a 10-year journey since then as a full-time investor. It's gone really well. We currently have 1,000 very nerdy, geeky investors that love data science, that love the data-driven approach, that invest with us. And we've taken over $300 million of their money to both buy and build many, many different kinds of assets, including multifamily. So it's been a very, very fun journey, all of it tied back to data science.
Yeah, no, that's awesome. And then, yeah, I know too, you guys are doing more build to rent and whatnot, just as you navigate kind of the waters here in the market. So I love hearing the backstory for sure. I'm always excited when I get a chance to talk with people who've had some experience, some longer term experience in the market. You had a lot of people that jumped in the last few years and all they know is hyper low interest rates and things that are not sustainable that you and I know, but anybody who kind of dives into who's either been in the market, who's been in the business for a couple of market cycles or an extended period of time, or is just willing to look at the data, which I know that you do, I think you'll see kind of a different pattern play out. So I love having you on the show and being able to kind of share your insight. But yeah, kind of Phil saying, what are you guys working on today? I know you're into a couple of different asset classes, not just the traditional multifamily, but what kind of projects are you guys working on today?
Sure. So as I mentioned, my first project actually was in reverse. Most people do a single family rental or fix and flip. My first real estate project 21 years ago in 2003 was to build a campus for my company. So I started in reverse. And then 5 years later, because of all the depreciation that I was getting from those campuses, I was able to save enough money to buy my first single family rental. So 2008 was the first time I purchased a single family rental and I bought dozens of them. And then 2014 or 13 was the first time I had greater than 4 units sort of purchased. 2014 was 237 units. And we continued to buy multifamily for a number of years before I started looking at development and development activity, because it was like, hey, this is something I actually know how to do. I learned it while building all those campuses. And so I think 2016 was the first time I built a building for a single investor, just one investor. It's called Art City Center. It's in Utah. And it was a very successful project. He still holds it. He has decided never to sell it. He's very happy with it. And then we basically moved on and started building all kinds of apartments. I built apartments as large as $106 million project budget, this $156 million selling price. Those were in Phoenix. I've built them in many markets around the United States. And a lot of it has been basically me going into markets that my data science tells me about. There's about 25,000 people that follow our data science each year. About 13,000 of them are following us using a website called Udemy, udemy.com. If that rings a bell, it's because it's a very popular website with thousands of courses. So on udemy.com/realfocus, or you just by Googling Udemy space Neal Bawa, you'll find that there's a very popular course with 13,000 students taking it right now. And these are people that are interested in figuring out the answer to questions like, how many metros are there in the United States? And which of those are the best for real estate investment and which are the worst and why, right? So these are questions that a lot of people ask, and these courses answer these questions. So each year I publish a list of my favorite cities in America to invest, and that is actually happening tomorrow evening with about 3,000 people signed up. And I take data from about 20 different vendors. We obviously have our own internal data science process that we go through, and we match those up and try to find commonalities. And so that's what we're up to. The biggest thing that we're doing at this point in time is something known as build to rent. And we've learned a lot with build to rent. We started one way and then had to pivot because we learned that the methodology that we were following was not as powerful as we thought. So build to rent is very different from a brand new apartment. If today you are building a brand new apartment, or if I am building a brand new apartment, it'll have one of those sexy infinity pools. It'll have a huge clubhouse. It'll have one of those massive gyms with glass all over the place. That's a description of everyone's brand new apartments, including mine. Well, build to rent is nothing like that. Build to rent is townhome communities, 100 to 150 townhomes, and no amenities except the townhome. So there's no clubhouse, no gym, no pool. It's just a bunch of homes that are townhomes. So they look like single family homes, but they're joined together. So there's 4 of them, 4 townhomes in a building. And the townhome is the amenity. It is for people that want a single family experience, but are simply unable, completely unable to get to that experience because of COVID. So before COVID, there was a reasonable chance that people with incomes or family incomes in their 60s, 70s, or even low 80s could buy single family homes. Obviously, certain markets are more expensive than others, but generally one would say, hey, you're going to live in an apartment if your income is in the 40s or 50s, maybe into the 60s. And if you're in the 70s or 80s, you'll probably buy a single family home at some point once you've gathered enough money. That dream has been completely, irrevocably shattered. I'm going to say that again. That dream has been completely, irrevocably shattered. Okay. And the reason for that is this massive increase in home prices since COVID. So when COVID struck, right, since then, the average mortgage in the United States has gone up 111%, right? 111%. And that's been a combination of 2 things. About 38% of that is home price increases. So home prices have gone up. That's the average, though in some cities they've doubled or close to double. And this is just since COVID struck, since 2020, since we talked last. And then the rest of it is just interest rates. So interest rates have gone up by roughly 3.8%. I mean, that's a shocking number because in 2020, interest rates were 3.5%, and now they're 7% or 6.8 or whatever it is. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, With no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. So that increase is so massive that as a result, today, you need incomes in the United States of $115,000 to buy a home. That is the median income necessary in the United States to buy a home. And the median income in the US for people who are looking to buy a home is $75,000. So what happens to all these people that make $75,000, $80,000, $90,000? What happens to them? They don't have any choices. The cheap states are not cheap anymore. Let me give you an example. If you want to buy a home in Orlando, you're looking at about $110K in income. In Austin, $126,000. Dallas, $115,000. The cheapest part of Texas is still Houston at $92,000. So what happens when you have an $80,000 income? You simply cannot qualify. What happens to you? You don't want to live in an apartment because until COVID, you were living in a home. You were the part of America that owned a home, the 66% of Americans, 2/3 of Americans. Well, what happens to you? There are tens of millions of you. Many of you have children, and you're an orphaned generation. We call it the missing middle that has nobody serving it. I'm not serving it because they don't want an apartment. They don't want a new apartment. They don't want an old apartment. They want to live in a home. They want to have a backyard, a front yard, nobody running above and below them, no smell of marijuana in the corridors. What happens to these people? For them, a new asset class has developed. It's called built to rent. And a built to rent community is just like those starter homes that you see in California and other places where it's a 1,300 square foot home, 3 bedrooms. It's nice. It's got 9-foot ceilings. It's got granite countertops, but otherwise it's just a home. And it's got a little backyard and a front yard. Well, this is like that, only the backyard's a little bit smaller. And the garage is 1-car garage instead of 2. And it's called built to rent. And it's a townhome instead of a single family home. Because if we were building single family homes, once again, brand new single family homes in the United States need an income level of significantly over 100,000. So what happens to the missing middle? Well, we can't make those single family homes for them. So we're making townhomes. So my goal in life, my mission in life, which I'm very excited about, and I've been at it since 2020, right after I came to your show last, is to build 10,000 of these, 10,000 townhomes in 100 communities over the next 6 years. And I call this mission10k.com. And I'm getting incredible traction from just people listening to podcasts saying, I want to be part of this. I don't know how, but I want to be part of this because this is an incredible mission. Because he's trying to serve not necessarily the poor people in America. Unfortunately, this mission doesn't work for them. But he's trying to serve the middle class, the people whose incomes start at 60,000 and go up to 90,000, where their chances of buying a single family home, even an old, small single family home, are just gone forever. And so that's my mission, and I'm super excited about it. My first Mission 10K community is now at 100% occupancy. And so I'm filling up the second one and working on the third one. And I have about 10 in the pipeline, so about 1,500 units.
That's awesome. Are these all, I mean, there's a few different things that I want to touch on just kind of in all of that, but just to kind of, quick question that came to my mind, are these all in the same market? Or are these in different markets around the US or?
They are in different markets, and I'm forced to do so. So one of the obsessions was, how do I get the median average rents in these communities to be $2,000? And so when I started out, people were like, are you kidding me? Even an apartment complex, if you build today, has averages of $2,000. You'll never get $2,000 for a brand new townhome with granite countertops and 9-foot ceilings, backyard, front yard, garage. You're never going to get there, right? And to be honest, they were right. The way they should have said it slightly differently, Steve, they should have said it is, in all of your favorite markets, Neal, you can't get there, right? And my favorite markets were through data science. So I would publish all these markets. A lot of them are in Texas and Florida and Tennessee and, Arizona. And the truth is, yes, in all of those markets, either construction costs are too high, or property taxes are too high, or insurance is too high, or land is too expensive, or city permits are too expensive. Once again, 5 major factors that kill most of these cities for me. So you've got construction cost, property taxes, insurance, cost of permits, land. These 5, I realized that I needed 4 of them to be in my favor. I didn't need 5, but I needed 4. And so I became obsessed with looking at every single metro in the United States, metros as small as 150,000 people, and metros as large as 10 million people, that's New York, to try and basically figure out these 5 numbers. And after figuring out those numbers, I started basically approving Mission 10K cities, numbers where 4 of these 5 numbers work. So of my favorite cities in the United States, only 2 have qualified as Mission 10K cities, and they are Raleigh, North Carolina, my absolute favorite, and Orlando, Florida. So in Texas, I can't make Tampa work. I can't make Sarasota work. I can't make Miami work. Basically, all of Florida, I can't make
Florida.
work, but Orlando worked. And the reason for that is Orlando's insurance costs are lower because it's not on the coast.
Yep.
So that was able to kind of just get Orlando squeezed into Mission 10K goals. And then I have other Mission 10K cities that are not superstar cities, but are sexier. They'll make us more money. This is a for-profit mission. It's not a non-profit mission. It's a for-profit mission. So we have to make our investors 18 to 20 IRR on all projects. And so that makes it even harder for us. So there are cities like Northwest Arkansas. So this is where Walmart's headquartered, Bentonville, Fayetteville, Rogers, that cluster, 500,000 people. There's Reno. So we've got 500,000 people in Reno, and Reno is an astonishingly good city to invest in, because I tell people Reno is a city in Nevada that is the cheapest Californian city in Nevada. Reno is the cheapest Californian city in Nevada because it's just over the border. A ton of the people that invest there are Californians, right? Who go there for fun, who go there for gambling, and who go there on the way to Tahoe for their skiing. So it's sort of like our Aspen. So when we want to ski, we'll stop in Reno, do the gambling stuff, and end up buying a second family home there. And so also, companies like Tesla that are fed up with California's red tape will build large, very, very large industrial complexes in Reno, often with thousands of people working at each. So it has that advantage as well, where they want to be serving the California market. They can't be thousands of miles away. So they're just basically 10 miles away from the border. So those kinds of cities are Mission 10K cities. And in those cities, my 5 metrics, at least 4 of them work. So I now know I can build homes for the missing middle American class without rent burdening them and making 18 to 22% IRR for my investors. It's just been sad for me to give up Texan markets, sad for me to give up all Florida markets except for Orlando, because I adore these markets. But a mission requires you to be extremely focused on success.
Yeah, and that's massive, and it's just a key differentiator. Again, this is where I love talking to experienced operators, experienced investors in the space, because like this, you're forward thinking, looking enough. For one, I mean, you're just looking at the data, interpreting the data. Hey, where are we in the market cycle? What can we do with this? Because we got to be able to deliver a product facing these 5 different factors too. Because again, the headwinds have been so strong, let's say on the interest rate side, on the land side, of appreciation, on insurance. I mean, that's a massive. So that's obviously something you were dealing with in all your data, pouring over all these Florida markets. Well, hey, guess what? There's so many operators in Florida that are getting killed because of the insurance issue. Okay, Texas, the same deal, insurance and property taxes, because you and I both know property taxes are insane in Texas. So you got multiple factors. I love that you're able to pivot, for one, because it also sounds like you've done that even within this new model. You've had to pivot. And this is what, guys, for all of our listeners, this is what every savvy investor does, right? You're continuing to add tools to the tool belt so that you can navigate during these different, not only within the market cycles themselves, but even within the same cycle. Hey, you know what? Factors change. This is a very dynamic space. So you have to be able to be nimble, to be able to pivot. Okay, what can I learn? What can I take away here? how can we make this better? Right. And it sounds like you're crushing that. And
And,
not
and
only
I want
that,
to add one little piece to that, right?
yeah,
So I'm a huge fan of people who do extremely difficult things. And top of that list, of course, is Elon Musk. So whether you like him politically or not, and I won't get into it, I think anyone who's reasonable would say that someone who has created 4 extraordinarily successful companies knows something about doing extremely difficult things. PayPal was the first company to be in the payment space. SpaceX is unquestionably his most successful company in the long run will be. It's definitely the most groundbreaking. Tesla, well, everybody knows about Tesla. And what he's doing with Neuralink is likely over the next 20 years to benefit humanity the most. All of these are doing difficult things. When I started doing this, one of the first things I realized is if I want to build in 4 different cities, the banks are not going to like me because I'm coming into brand new cities all the time. They don't know who the hell I am. So I realized that I needed something unusual. So I went around to the banks and said, when a brand new company comes in, what are you really afraid of? And they said, well, we are afraid that they won't finish their projects on time, on money, and they'll get stuck. So I said, okay, what if we could design something extraordinary and unusual? Like, in addition to having contingency in my construction budget, which everybody does, they expect it.
right.
What if I gave you $1 million per project? And that $1 million a project, so if I did 4 projects with you, $4 million would sit in your bank, okay? In your bank, raising your deposits, which they love. And it'll be in a money market account, so I'm getting interest. And I will give you a written guarantee that if I go over on any of my projects and fail to bring more equity in, you can pull money from this $4 million that is sitting in your bank account. Wouldn't this be much better than making me sign a recourse loan? Because if I had a recourse loan, you still have to go after me personally and find my assets and pay millions of dollars to lawyers. Wouldn't it be nice for you to have $4 million in your bank account? They said, if you could do that, nobody ever has, we would give you all the loans in the world that you would need. So then my question was, okay, I've found something that every bank loves. How do I get my hands on $4 million that I don't use in the project? So I went back to my investors and I said, I need you to give me $50 million of your money to create a company. This money will not go into a project. It'll not go into real estate. It might go into real estate, but differently from where it normally does. I want you to invest into my company, just like Elon Musk is inviting people to invest into his companies. People buying Tesla shares are investing in Tesla. So I created this company. It's now called Mission 10K. It used to have a different name before. And so now I have money in my bank that I can move over to Raleigh, North Carolina, or Orlando, Florida, $4 million each. And now those banks are not only giving me loans, they're giving me non-recourse loans at low interest rates because their biggest fear has been taken away. So I think it's very important, in addition to everything you just mentioned when you were talking just now, that you also think outside of the box. Come up with solutions that no one's ever come up with before. This is a solution I invented, and maybe I should patent it at some point, but though I don't think I can, simply because it's so powerful that banks are all of a sudden have gone from being those conservative groups to being, oh, let's be aggressive with this dude because he puts $4 million of his deposits in our bank. I don't know where he got the 4 million. Well, I got the 4 million because I convinced 200 investors, and you can check them out at mission10k.com, mission10k.com. And you'll notice how much money we have $60+ million in the bank. And we did that by showing people a vision. So what happens a lot in syndication is the vision that people are showing is very limited. The vision that I hear 99% of the time is, we are going to buy a building. It's old. Its rents are low. We're going to rehab it and we are going to increase the rents and we will make you money. Now, there's absolutely nothing wrong with everything that I just said. I have seen people do it. I've done it a half a dozen times myself where all of this stuff has worked and people have doubled or tripled their money. But that is in a way vision. I never hear people saying what fundamentally they're doing. What are you doing? What are you actually achieving? You are taking stock that is now 40 years old, housing stock, and is getting worse and worse and worse, and eventually will become Class D, essentially, and only the people that are okay with gunshots and everyone having 3 pit bulls is going to live there. And you're taking that stock and you're bringing it back to the mainstream where middle Americans can go live there for the next 20 to 25 years. In essence, you're preventing stock from being demoed. This is a true service for the country. You're actually raising the country's stock without needing to build more. Well, Steve, I haven't heard anyone say that. I haven't heard one person say it. But that is your mission when you go out and rehab these properties. I just find that people are not looking into their heart for what it is that they're doing.
I love that. And you're absolutely right. Like just in terms of being able to create and serve a gap in the marketplace for one, right? Us as entrepreneurs, we're only compensated for the level of value that we're bringing to the marketplace. So you have come up with something unique there where it is a compelling vision, right? And that's something that people can get behind. We're based here in Hawaii, and there's a profound sense of community and a desire to want to give back to the community. And I think if you ask most people, right, like, of course, like they're concerned about like their own financial needs, but in general, I feel like people want to do good. They want to feel like, okay, hey, great, I can give something back to the community. So this now you're able to kind of tap into a couple of different facets here. Not only are you able to deliver returns to the investors and the people who are savvy and, hey, yeah, absolutely, I need to get my money moving, but you also kind of check the box and scratch the itch for these people who are altruistic, have resources, and hey, look, I can also feel good about doing this because it is actually serving a need in the marketplace. So you're delivering value on a couple of different fronts there. Just to your point there, you're creating something new that these banks haven't seen. And not only that, just from a practical sense, we were talking earlier about, let's say, insurance and property tax and whatnot. Well, hello, you just skirted around the insurance challenge. We're seeing them crimp down so hard now on old stock because they're worried about, hey, well, what kind of improvements have you made? Do you have, let's say, 4-point inspections for anything out in Florida, right? Do you have hurricane? Well, guess what? It's new construction, right? We don't have to worry about that.
It's brand new construction.
Right?
And brokers are loving it in the markets where these numbers are low. I can tell you, I have properties in Texas, and I have properties where my insurance per unit is $1,500. And I'm now building brand new properties. Can you imagine how much nicer they are, taller, all those kinds of benefits, where my insurance quotes are $300. That's 20% of what I'm paying. Now, this has a practical side to it as well. When you sell your building, any building, old or new, the price that you receive is a multiples of something called NOI, or net operating income. So if your NOI is $1 million and you're selling at a 5 cap rate, you're getting a 20x multiple. So 100 divided by 5 equals 20. So that 20 number, you multiply by $1 million, you'll sell your building for $1 million. What most people don't understand is that there are markets in the United States where that NOI is much easier to hit, that $1 million, than a place like Texas, where you're taking many different hits, including property taxes and insurance. Where if you went to a state that had low property taxes and low insurance, then you don't need to worry about that. And you can hit your net operating income with your rents being much lower. And you don't take the chance of having to raise rents by $250 a unit. You can raise them up by $125 a unit, and you can still get to that math. You can still get to that number. And people are like, yeah, but Texas and Florida are the fastest growing markets, so I want to be in there. And the answer is, that's complete rubbish. When you say stuff like that, you're not a data scientist. You're not even an investor. You're a speculator. Here's the truth. The number of people moving into Texas and Florida, respectively, are the highest. Texas being number 1, Florida being number 2. But that's because they are the 2 of the largest states in the union. If you look at the top 4 largest states in the union with the most people, Texas and Florida are in there. So it's not unusual that they would be number 1 and number 2. And they are consistently one of the fastest growing states in the United States. But in the last 5 years, neither Texas nor Florida are in the top 3 in any of those 5 years as fastest growing states. The fastest growing states in the United States are states you probably haven't even thought about. Did you know Idaho and Utah are actually the fastest growing states in the union? So there's this tendency to follow what everyone is saying and accept that as fact, especially if it's on social media. It must be true. Almost everything on social media, it has some grain of truth, but it's largely useless because everyone knows it and everyone accepts it as fact when there's only a grain of truth in it and the rest is unknown. As a data scientist, my job is to follow every market in the United States, 323 of them in the US, rank them. And ranking them is also useless because, Steve, what I'd like to do is rank them and then follow how they change every month. So a market being number 1 in my list, I don't care about. Number 1 in my list twice, I don't care about it. But what if it's in the top 5 for the last 12 months? Now I get serious.
Right.
What the heck is this place called Rogers, Arkansas? I don't even think of Arkansas as a high growth market. What is happening in Rogers? Let me catch a flight, go over there, understand why this market is consistently crushing every major Texan market, every major Floridian market, every major Californian market. So when you go there, you learn a bunch of new things. Oh my God, Walmart has a mandate. They are forcing all of their middle management from 50 different states into this one tiny area. And they're saying, you can't really be employed with us if you don't do that. So when you have a mandate and it goes over a decade, that changes a market, just like Starbucks and Microsoft and Amazon changed Seattle. I mean, if you knew that these 3 companies would radically change Seattle over a 10, 15-year time frame, you would invest every dime you had into Seattle. That's what we are looking for. So Wilmington, North Carolina, everyone talks about Raleigh. I talk about Raleigh too. But right now, actually, the fastest growing market in North Carolina is a tiny 295,000 person market called Wilmington. It's on the coast, by the way. So definitely have to deal with insurance issues. So my goal is to continuously look at these markets. My favorite market for the last 8 years has been a market called Provo, Utah. In 2016, I said, this is going to be the most phenomenal market in the United States. So I do this real estate trends thing. So in 2016, 2017, back to back, I named it City of the Year. And that happens in January, February every year. So that's why a lot of people come to us to get this data. 3 years later, in 2020, and then again in 2021, Provo won City of the Year twice, back to back, the only city ever to win back to back. Nobody knows where Provo, Utah is, even today, 3 years after it won City of the Year.
Yeah. And this all comes from not only following the data, but following it like hyper closely, like being hyper aware of what's going on. Yeah.
I am obsessed with data. I'm obsessed with not just data, but the insights that come from that data. What is happening in Provo, right? Like, why is Provo so special? The short answer is Provo, and I'm giving you examples just to open people's minds. I don't think Provo is a great place to invest today. That ship has sailed. Bottom line is Provo has the trifecta. It has amazing low-cost universities, so UVU and BYU, they're both top ranked. It is part of Silicon Slopes, which is Utah's technology corridor. It anchors it. And the third one is it has a world-class skiing 20 minutes away. And that last part is not a joke. There are people who come as students, graduate, and then open .coms there because they don't want to get away from the 20 minutes, away, some of the most amazing slopes that you can see anywhere in the world, sheer slopes. So those people stay because Provo becomes part of their lifestyle. And so it is an extraordinarily sticky city. It's the only city in the United States that has the trifecta.
That leads me to another question. And it's like, have you picked up skiing? Then, since it was
I
such a
have
top
not,
city over
it's just because the first time I tried it, I fell and was injured. So I guess that I didn't go back to it. But of all the things that I want to do, skiing is something I want to learn. I'm taking a 7-day trip on the newest cruise ship in the world. It's called Utopia of the Seas, and comes out in a few weeks. And so for 7 days, I want to learn how to do ice skating because I've heard that if you ice skate, then it's easier for you to learn skiing.
Mm-hmm. The core strength and everything else. So,
core strength, yeah, knee strength, yeah.
Oh, that's awesome. Well, that's amazing. And so for like all of our listeners, again, it's not saying abandon your strategy, but through Neal's experience and his example setting is, hey, look, they think outside of the box. When you've got to, in order to do that, you've got to be aware of where is the box? What is the current box? Like, what are we working with? What are the standards and kind of the norms that people are used to being able to operate in? You got to be able, okay, well, yeah, but let's stop. Let's look at the data obsessively. And we have to fill a need. You got to bring value to the marketplace in a way that nobody else is doing, because then you're creating something special, something unique. And obviously you guys are doing that with your built to rent model. Because I mean, that is incredible. And also too, I mean, you have such competitive advantage going into any of those marketplaces, because then you're able to throw a product that's new, that fits that specific need, that's really fitting that need in the marketplace. And it's true. I mean, most of you guys, you're actively investing, but they're not building that kind of stock anymore. They're just not.
Nobody's building it because the builders are actually making more money building single family, and we need them. They're building 1 million homes every year, single family. We need all of those millions. So builders, you keep doing what you're doing. but we also need 100,000 units, so 10% of that single family market, to be single family rentals. Whether those are single family or townhomes, doesn't matter. It's really the same audience. So we need that 10% gap, 100,000 units a year. And last year we built 17,000. So we're at the point where we're a fifth of what we need. Now, the apartment market is also underserved, but I can tell you the apartment market is roughly underserved by 20%. The build-to-rent market is underserved by 600%, right? That's the difference. So the apartment market, 20% more, we would be at equilibrium. The build-to-rent market would have to grow by 6x. My job is to move from things as they become more saturated to things that are less saturated and find a way that's a win-win-win. When I put money from somebody else into my build-to-rent property and double their money in 4 years, that's a win for them and a win for me. That's a win-win. But what if there was a third win? Think outside the box. What is that third win? I give investors shares in the company that builds those BTRs. So over time, as the value of that company grows into the hundreds of millions, the investors get a second win beyond their project, right? They're not just part of some project in Provo, Utah, or Raleigh, North Carolina. They're also part of the company itself that built those assets. And so if you build a strong level of competency in the company also has value. If I tell syndicators, and there's a lot of people, syndicators listening to this right now, what is the value of the company that does the projects? Anyone reasonable who understands these things would say that value is zero, Neal. All of the value is in the projects. That's how we make money. So my question is, okay, so Steve has been doing this now for 40 years. He's now almost 70. So Steve F wants to retire. What's he going to do? Well, the answer is he's going to stop doing syndications. Yes, but what about the work that he did, the company that he set up? Well, it can't really be sold. My goal is to fix that hard problem, which exists in all syndication, that the value is only there as long as you're doing projects. Mission 10K is designed so that the core company creates value in itself, whether that's through modularization, fractionalization, finding ways to build faster, finding ways to increase profit, create brand in these BTR communities. I mean, I'll throw out 24 ways in which I'm doing this, but in the end, you become unique simply because you're building stuff. The vast majority of Tesla's value is not in the cars. It's in the technology, branding, and market position. And I encourage everyone listening to this that you shouldn't just be satisfied by doing syndication and making money for your investors. You need to go the next step and say, how can the core company that does this have value? Like I'm talking about Tri-City Equity Group, the logo that's behind Steve. How can Tri-City Equity have its own value? Because and how can I also give some of that value to my investors, not just for me, but also for my investors? That creates win, win, win.
Yeah, no, absolutely. And again, that's a unique product because now, again, you are thinking far outside of the box because most of the operators, really all the operators that are in the marketplace today they don't have a product like that. So no, it's amazing. And I thank you for sharing with me. Thank you for sharing with our listeners, our audience today. Well, I know you're going to have a lot of people that are going to want to reach out and kind of learn more about you guys and what Grow Capitalist has going on, how they can be a part of your life project here and how we can get some more information. What's the best place to be able to connect with you in regards to that?
The absolute best place is to go to a website called multifamilyu.com. That's multifamily followed by the letter u.com. All of our research that we publish, very entertaining, very fun, by the way. We publish all kinds of interesting, fun research that you wouldn't think about, all related to real estate, is published at multifamilyu.com. What's good is we don't have an educational product. We're never going to have one. There's no subscription, no upsell, no premier membership. Everyone gets the exact same thing. People come there every year, 25, 30,000 people, take the data and use it. And the only thing that we ask is if you did it in a way that extended our tools and techniques, please let us know about them so we can copy you. So other than that, it is just like a Wikipedia type community. Now, every time we do a webinar, we will spend 60 to 90 seconds pitching you on some of our projects. And you can fast forward through that because we also send out video recordings. But that's the only way in which you can really interact with us and say, hey, yeah, I want to be part of this community. Once you believe in what we do, once you believe in what we believe, you're welcome to join some of our projects.
Yeah, no, amazing. And Neal and their team have just put out some of the most amazing content over the years that we've been tracking along and following all the information. I mean, if you guys have found value in this brief interaction, this short interview with Neal, you got to know that he's over delivers on everything that he's talking about. So I really appreciate you. I really appreciate you coming on and sharing with our audience and giving us some insight into not only what it takes to be a successful investor, but really just how to challenge kind of the status quo in terms of thought process and how they go about their day-to-day operations and in terms of real estate and really what they're going to need to do moving forward. So, no, I love it. And I really appreciate you coming back onto the show, Neal. We'll have to check back in with you too, because I know that you've got that goal. You're going to knock it down. So I'd love to circle back with you in the future and make sure and say, okay, wow, Neal, you pushed that goal up to that 100.
That's my intent. The day I hit it, I'm going to change it to 100K.
No, I love it. Well, thanks so much for coming back on with us today. I really appreciate it. It's always a pleasure listening to you. So I thank you for revisiting with us and our audience. But thanks again. And like I said, we'll circle back with you and to keep tabs and to touch base. I really appreciate it.
Sounds good. Thank you.